Well, welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Mike Zalin of Madrone Investment Advisory. Our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour north of San Francisco. Weather's getting good. Check them out. The vacations are free. Their only request is a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme, since we have Mike Zalin back again, and he does have a legal background, is general legal concepts. See if you can remember that from
everyone's favorite topic.
Everyone's favorite topics. Okay. Check us out on Facebook, bestofinvesting.com, and we're also on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Mike Zalin, we got something here for you. Talk about conflicts of interest, would you?
Yeah, well, in the financial services and investment industry, they're quite common. I guess that's no surprise. They're either potential or they're actual or one form or another. But, you know, it's funny, people often say, well, brokers are held to a suitability standard and registered investment advisors are held to a fiduciary standard, and the fiduciary standard is better. I would agree with that. I don't think that's really in dispute, but the fiduciary standard isn't foolproof. I'll give you an example. Let's say someone were to come to me as a registered investment advisor and say, Mike, we're thinking of investing in the stock market. In which case, presumably, if I manage their money, I would make ongoing fees for managing the money.
Yeah.
Or they say, but you know what? We're also thinking of paying off our mortgage with that money, and so there's a potential conflict.
Because you wouldn't, once they pay off the mortgage, there's no investment money.
I'll get a Christmas card. Maybe.
Yeah, exactly.
And so so those things are real. They do happen, and ultimately, fiduciary or otherwise, I mean, you have to bring enough integrity to the business to be able to say, well, what am I doing here? Am I, will there not be enough clients out there who do really need to have their assets managed in the stock market, or does everybody? Do we need to persuade every single last person to do that? And so the answer is, of course, no. There are people who need money managed in the market, and there will be people who should pay off their mortgage because they'll sleep better at night.
You know, Mike, that's actually a really good example because I've heard like call-in shows when I've been listening to radio on the weekends myself, and sometimes that question comes up. I just, I got an inheritance of several $100,000. Should I invest it in the market? I'm afraid that maybe the market is a little bit high right now, or should I pay down my mortgage? Now, what would you expect a financial advisor to say?
I'm going to put one of those hats on. How can you pay off your mortgage at 4% interest when we could get you more in the stock market or some annuity or blah, 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 blah?
Well, and of course, the honest answer is no one knows what's going to happen in the stock market.
Exactly.
And although historically, the S&P 500 has returned compounded 7, 8, or 9%, whatever, over whatever period of time you want to use. That's not going to matter when the market goes down 50%.
Exactly.
The person's lost sleep, and they're going to lock in their losses and wonder why they didn't pay off their mortgage.
Yeah, and also, the first question I would ask is before the mortgage is, do you have any outstanding credit cards that are paying 18% or more?
Well,
because that's a guaranteed rate of return.
And that goes to a good point too, which is that before anyone can even determine whether someone should be invested in the stock market, the bond market, real estate, or anything else, you really need to look at their whole financial picture.
Yeah.
Do a little bit of a psychological profile,
Absolutely.
Find out what their risk tolerance is, the normal due diligence, and then lay out the options as fairly and completely objectively as you can. Why for example, would an annuity be better for this person in retirement than being in the stock market?
Yeah, because it's a guaranteed income.
Absolutely.
Yeah, because there's, how do you put a price tag on just knowing being debt free?
Absolutely.
That's you just can't, maybe how many more years do you live because of the less stress?
Yeah. And I can say these are the pros and cons of an annuity. These are the pros and cons of real estate generally. These are the pros and cons of stock market, bond market. Bitcoin, whatever.
Well,
Bitcoin, yes.
that's why you buy
Anything new and shiny, I like.
yeah, that's why you buy $10,000 worth of forever stamps because then you're guaranteed that
I
they
like
won't
that.
go up.
I never actually thought of forever stamps as an
Inflation.
asset like Social Security.
Now, if we can get the real estate taxes that way, where you can basically, I know property can lower them, but you have to pay you don't have to pay your mortgage, right? If you pay it off, but somehow that real estate taxes, you always have to pay that.
Yep. Hey, Mike, you mentioned annuities, so I keep seeing these full-page ads in the local papers from some guy that says, "I hate annuities." What are some of the pros and cons of annuities? Why do people invest in them, and why do some people hate them?
Well, let's take the most, I think, simplest kind of annuity and probably the safest, which is the fixed immediate annuity, where basically you're 70 years old and you have $300,000 and you hand it to an insurance company and they, let's say, give you something like probably around $20,000 a year would be the going rate, guaranteed for life as long as you live. Of course, if that happens to be the next day, well, they've made a lot of money. But actuarially speaking, they're intending to make a profit. And so the normal thing is that you're basically going to go at least 15 years. You have to live at least 15 years before you just break even on the investment. You're just getting your money back over that time. So really what they are is it's a form of longevity insurance, but even more, it's a form of an insurance against losing your money in another form. You can't lose that money in the stock market or real estate or any other. So you're really making a good insurance decision if that's right for you. But that's really what you're doing. It's not so much an investment; it's an insurance policy.
So
it's
not
yourself.
So it's not that they're inherently good or bad. It's just that depending on your situation, there might be, in your opinion, right? There might be better investment options depending on your age and your risk tolerance and what you want to earn.
Well, especially when Guido with the sunglasses helps you fill out the application for the insurance company and follows you around.
Well, if not Guido, then Joey the Fixer.
Joey the Fixer, exactly. Okay, hey guys. So we're going to cut to a quick commercial break here. Again, the theme is general legal concepts. These actually were pretty easy, I gotta say. Which founding father defended the English soldiers who were indicted for the Boston Massacre? Which, by the way, I think only 5 people died in that massacre. All right, the first 3 callers with the correct answer. That was a massacre, all right. The first 3 callers with the correct answer won a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. Which founding father defended the English soldiers who were indicted for the Boston Massacre? So this was before the Revolutionary War, and he was actually defending them. All right, stay with us. You're listening to The Best of Investing, and we will be right back.
So it wasn't multiple choice. That's not fair.
We would know. Okay, well, let me go through the 84 guys there.
The 84 guys, yeah, you got to go through all 84.
I'll predict that it was a white male.
Yeah, there you go.
Who wore a white wig.
Yeah.
And who belonged to the Whig Party, which I think is where that came from.
The Whig Party.
But that's WHIG, but that's okay. It's probably the same, though.
Well, isn't it pronounced Whig?
Whig, yeah, exactly.
What?
Like,
Who?
Whipped cream? Who was
Whipped cream.
Right?
Whipped cream.
That's what they're called, the Whigs, because they pronounce their, like,
yeah,
Stewie.
that's right.
Whipped cream.
Oh my God, Edward, come on, these questions.
Whig.
Who
was a lawyer back then?
So
they were all lawyers, weren't they? All founding
Well, I
fathers.
think they were all planners.
well, it's funny. You said that he's probably white. Well, it reminds me of the
Just a
joke
wild kid. And Christian.
and Christian. Yeah, the joke about it's like it's a white black thing. Okay, so 2 white prisoners and a black prisoner, and the warden asked the first white prisoner. He says, basically, I'm going to ask you a question, and if you can answer the question, you get to go free. So the first one, he says, okay, what was the name of the ill-fated ship coming from England over to America in the early 1900s? Titanic. That's correct. That's the next guy. He says, what year did it sink? 1912. And, or actually, no, I'm sorry. What year? Hold on, what year? He goes, and how many passengers were on it? He goes, 1,514. He goes, that's correct. He asked the black guy. He says, Name them.
Oh, that's just me. That's the voting test.
Yeah, exactly.
Can't be a citizen unless you can nail them all.
That's it.
They used to do that too. That was the voting test. That's why 3% of the black population in Alabama could vote in 1960.
Because
They would ask them name every state legislator, or that's the vote. That was why the Voting Rights Act was passed, so you couldn't discriminate.
Did they ask white people out too?
No.
See, that's not. I mean, it's
Well,
one thing.
obviously.
Yeah.
Yeah.
I mean,
But no, that's why the Voting Rights Act had to be passed. It was up to state law before that, and state law could just make it up. No, seriously. That's why
Is that what it was?
It was 3% of the black population could vote in the South in 1956.
I'm impressed that 3% would even know that.
It just shows you how educated the rest of it must have been. I don't know if it was 3%, but I made that up, but it was low.
Yeah.
I'm sorry.
Yeah. Okay, here we go. Let me try this again. Let's not do that one. Wow.
Drink your pink water.
Yeah.
What else you got there? Any other goodies?
No, that's, we could talk about
Oh, yeah.
conflicts of interest forever.
Yeah, that's true.
All right. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Mike Zatlin. When we cut to the first commercial break, we asked this trivia question about general legal concepts. Which founding father defended the English soldiers who were indicted for the Boston Massacre? Mike?
Well, I think Thomas Jefferson was a lawyer.
Okay.
I'm not sure.
No.
John Adams.
Yes!
Ah,
You are the
guess.
man, John Adams.
I thought you were going to give like multiple choice or something. when you asked the
No.
question.
In fact, again, the next question I think is easy, and the last question maybe a little harder.
All right.
Okay. Was this John Adams or John Quincy Adams?
No, it was John Adams, because John Quincy was too young at the time. In fact, he was barely born. You have to see you know how we know this? Is if you watch the whole series on John Adams, played by Paul Giamatti, played John Adams. Very good.
That was
Very
great.
good.
Yeah, I didn't see all of them. I saw like half the episodes.
Okay, now, next week we are going to have another special trivia contest. The winner is going to get 2 kayaks to kayaking on the Napa River via the Napa River History Tour. Napper. I'll take a napper on the Napa River History Tour. Beautiful 2-hour kayak tour as they discover wildlife and explore Napa's most revealing and provocative secrets. Perfect for all fitness levels and experience. They include the kayaks, the life jackets, and the paddles. All you need to do is show up and enjoy. Call 707-227-7364 or go to NapaRiverHistoryTour.com. Here is the question. About 80% of people say they have faked this more than twice a year. What? All right. Now, here are the rules. No previous winners on the Best of Investing. You have to email edward@bestofinvesting.com by midnight tonight. The answer we'll take from among the winners, from the correct answers, and randomly choose it, announce it next week.
All right. And this kayak trip required no fitness level, right?
That's correct.
Okay. Yeah, I'm in.
Okay, there you go. Yeah, actually, you're pretty fit. Okay, Mark, you got some good fun stuff for us.
Well, it's time for another episode of This Week in Real Estate. So, this week in real estate, we had a bunch of headline news. Home prices in 20 U.S. cities increase at faster pace, says Bloomberg. And where else do we have? Home prices picking up the pace, according to Case Shiller. That was Mortgage Professional America. Well, what really happened was, in December, the year-over-year price appreciation for the San Francisco Bay Area was 9%. Well, in January, it dropped to 8%. It went down 1%. So on an annualized year-over-year, it was up 8%. Well, in February, that picked up again. February went up 2 percentage points, so now we're at a 10% annualized appreciation rate. But really, statistically speaking, 9, 8, 10, that's just a little bit of a dip. Now, of course, the media has to talk about something, so a 2% jump feels like, oh my gosh, we're back to bubble rate in price appreciation. No. It's just really statistical anomaly. In my opinion, in the last 6 months, real estate prices have been essentially appreciating at a pace that has been fairly steady, right around 10% in the San Francisco Bay Area, 5%, between 4 and 5% nationwide. So really, there's no news there. Some other news for the week, though, that's been coming out is yet more articles about millennials not buying homes and Americans in general less optimistic about home buying. In fact, well, because it's a lot of them. Well, millennials are more interested in renting than they are. And there are many societal reasons for this.
A lot of moving around, maybe?
Well, and I think they like the flexibility and maybe more moving around. But one of the main reasons, the obvious reasons, is housing prices, are actually quite a bit out of the reach of some younger buyers. And just in general, it's hard for pretty much everybody today who wants to buy a home. Multiple offers, getting outbid on a home, not getting the home that you want, people giving up and deciding to rent for a while until something happens in the marketplace where maybe more inventory comes in. So there's a lot of frustration out there among home buyers and people who are seeking homes. And it's interesting, getting back to the millennials and the fact that they're not buying homes right now. Is here's another article that was in Bloomberg. They're calling it the $700,000 mistake nearly 6 in 10 millennials may be making. And that's in respect to the fact that a lot of them are electing to rent as opposed to buying a home. Now, $700,000 is the number that they calculate on average over a 30-year period that they'd be paying in rent and getting no economic or tax benefit from that, from home ownership, price appreciation, investment returns, etc. I think it's, it's certainly if you're a millennial and oftentimes you're not thinking 30 years ahead, although I wish I was when I was I am not a millennial now, but it's a hard argument to make when the fact of the reality today is, maybe I'd like to be a homeowner, but if I can't because I can't qualify or I can't find a home to buy or I keep getting outbid, I don't have the down payment.
Or I don't want to take care of the lawn.
Well, we did talk in an earlier show about how those millennials that are buying homes, they prefer low maintenance homes without a yard. Condos, townhouses are very popular among younger buyers now than say your house in the suburbs. But given that we've got such a tight inventory right now, certainly at least the real estate industry and realtors themselves have yet to feel the pinch. There isn't any negative impact on the real estate market, realistically speaking, from the lack of millennials, because we've got lack of inventory and there's enough people who want to buy homes that can't, that are making up for that. But looking ahead, if we ever get to a time where we actually have a normal real estate market again, where we're actually building homes in California and we've got inventory, the fact that millennials not buying homes might actually have a long-term impact on real estate and the real estate
it's because
industry.
The open space, we were just talking about this morning at breakfast that it's amazing that, Marin, like as an example, Marin open space. If they own all this land and they're not going to build on it, then, there's not building, right? You got to find somewhere else.
Well, and that's probably one of the main reasons that Bay Area real estate goes up far more than most of the rest of the country. Is you can pretty much go to Texas and build until you're as far as the eye can see. But in Marin or in parts of the Bay Area, it's much harder. So I'm sure that has a lot to do with it.
Well, and even though you've got states where you've got plenty of room to build, the home ownership rate continues to decline. It's now below 64%, and it's at its lowest level since the 1990s. And then, in addition to that, additional real estate news: the Fed's saying that they're continuing to toe the line and hold rates where they are. They're not saying when they're going to raise rates. They're pretty secretive about that. But this one article thinks that a hike could come later this year. Of course, earlier in the year, everyone was basically saying we were definitely going to see the prime rate begin to. The Fed will increase rates this year, and now we're not so sure. And then, last but not least, we've got the Housing Wire and the Wall Street Journal and a whole bunch of other media outlets reporting how U.S. economic growth has just about ground to a halt when they've gone back and readjusted first quarter economic activity. They're saying that the United States market is up just 0.2%, so statistically flat. What does that mean? I don't really know.
I was waiting for you to tell us.
If I did, I'd be a very, very wealthy person.
All right.
But one of the great things about real estate, using the term this week in real estate for our little episode here is a little bit tongue in cheek, because the great thing about real estate is nothing happens fast in real estate. Real estate is a very slow moving train. It goes up slow, it goes down slow. It may feel fast, it may feel frenetic, and the newspapers love to sell paper, and they want to, if it bleeds, it leads. So, but the really good news is, there isn't anything on the horizon that I can see that there is to fear in real estate right now. We seem to have a fairly robust market, and if we could only build more inventory, I think that would make an awful lot of people happy.
All right. Thank you, sir. We're going to cut to a second commercial break. When we come back, I want to ask Mike about participating in employers' 401k plans. You're not going to want to miss it, because I know that there are a lot of people who are listening who are employees, and they're wondering if it's, what to do with their employer 401k. Here's the second trivia question again. It's general legal concepts. What is the Latin term for buyer beware? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. Mark's writing this one down. He knows this. That's 888. I know you know this too, Mike. 888-912-1190 to answer this question. What is the Latin term for buyer beware? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial, because we will be right back.
Do we have to pronounce it correctly?
Yes, you do.
And right, and it's spelled in the original Latin.
Yeah, so
Or
that's right.
Aramaic, whatever.
Using the actual Latin letters.
Excuse me.
Aramaic. Did you get that on camera?
Yeah, I did.
Hello.
That wasn't me, by the way.
Sorry.
Not well.
No, I'm feeling fine now. Boy, I tell you,
You sound fine.
yeah.
I still have the $100 million homes if we want to talk about those.
Oh,
later on.
yeah.
If we have time for that at the
Okay,
end.
well, you're okay.
We have a couple of minutes at the end. That'll be fun.
So, shall we talk a little more about conflicts of interest?
Yeah, let's get into because we're going to talk
That's a
about
really
401k.
interesting subject.
Yeah,
actually.
it is.
Even fiduciaries, they'll never tell you that, though.
What about fiduciaries?
Fiduciaries happen. Lots of them.
Of course.
Thank God.
Yeah.
You want to start uncovering all the hypocrisy in the world? Just stay here all day.
Yes.
That is true. It's true. Are you red-eye?
Yes.
Here we go. Well, welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Mike Zablin. When we cut to the second commercial break, we asked this trivia question about legal terms. What is the Latin term for buyer beware?
Do we have to pronounce it correctly?
Yes, you do.
You say the first word, I'll say the second.
Caveat?
Emptor.
That is correct, and I learned that on the Brady Bunch episode.
Not recently, I hope.
No, well,
Everything
yeah,
you need to know in
yeah.
life to be a success, I learned from the Brady Bunch.
That's right, exactly.
And Partridge Family.
Yeah, so I love those shows.
And Batman.
I'm getting a little aging myself a little bit here. So, Mike, one of the emails we received said, "Does it always make sense to participate in my employer's 401k?"
I would almost unreservedly say yes, with the only reservation being that you are looking at a 401k plan with very high fees. But even then, if you're getting a company match, that's an automatic 50 to 100% return.
Yeah.
And if you're in a high tax bracket, you'll just have to eat the fees. Fortunately, most 401k plans are getting a lot smarter as plan sponsors realize that they're personally liable as fiduciaries for high fees. Interesting, can be. And so there's of course a lot more attention focused on fees and low costs and index funds, and plan sponsors who are usually the last often to find out, because especially small ones, because because they really are very good at running their own business. They don't have any particular knowledge about investing.
So let me ask
Pretty
you,
much rely on brokers to sell them a plan, and that can create problems. But just to answer your question, you really do want to.
okay, how often do you get the question about taking some of the 401k and putting it into the employer, with the employer stock? Well, of course, you don't want to do it like an Enron, but obviously you don't want to put
Not a good idea. Not a good idea because you're going to become very undiversified. You already are making your livelihood from that company.
Okay.
So to then own stock in that company generally would cause. What if there was a problem with the company? You were laid off and your stock went down. So there'd be a lack of diversification.
Okay,
I don't recommend it at
usually
all.
you don't recommend
No.
it. Okay.
Unless, it's possible there's situations where you're getting maybe a break on the price. I'm not sure of the options or how that really works. The 401k plans I work with don't usually have employer stock.
Okay,
They're
well,
smaller
usually
companies
smaller
too,
companies,
exactly.
yeah.
But yeah, look, first of all, if it's a public company, it's already going to be a member of maybe the S&P 500 or a small cap index.
Sure, so
you're already there.
You're with one of your mutual funds.
But I do think it gets a little dangerous in terms of a lack of diversification because you're already making your livelihood from that company.
Interesting.
The other thing I would point out is, as far as participating in the 401k, one question is, well, if you're in a really low tax bracket, say you're just starting out or you have a lot of deductions, try and put that into the Roth 401k portion because you're not going to get a tax break from the 401k deduction either in any case.
Do employers match that part?
The employer contribution always has to go to the regular 401k. Can never go to the Roth. Only the employee portion can go. So you could, as the employee, if you're under 50, contribute $18,000 in a Roth 401k contribution. But then let's say the employer matches it, that employer contribution is only going to go to the regular 401k.
Okay, because I was going to say that you don't want to jeopardize having free money from the employer.
Right, but you'll get the match either way.
Okay.
So, but the thing is, the employer match will not go into the Roth portion.
Okay. But that's fine because it'll still grow tax deferred.
Yeah. So yes, 401k plans are great because of almost always because of the match. And let's say you don't get any match. Well, you're still able to put away $18,000, whereas in an IRA you can only put in 1/3 of that or so.
Yeah.
A lot of benefits.
Okay. Luke, move on to Mark here. So, Mark, we have an email from a listener that says, if I invest, this person's obviously been listening to our show for quite a while, it says, if I invest in your fund, can I add to my investment, and can I change from monthly distributions to reinvesting?
So for a quick background, what do they talk about invest in your fund? So I'm the president and broker for Pacific Private Money Loans based in the Bay Area here. We're an alternative source for real estate financing for consumers, real estate developers, flippers, you name it. Anyone who got turned down by a bank oftentimes ends up coming to us for a quote for a real estate loan, either purchase or refi or renovation loans, lines of credit, you name it. We do and consider all kinds of lending. We're an alternative to bank financing resource for the real estate community. Now, we fund all of our loans with private capital, and one of the investing options we have for our more than 250 clients and growing is the so-called Pacific Private Money Fund. It's a mortgage pool fund that we created a couple of years ago because of the fact that we were getting a growing and more and more people were calling our office looking for opportunities where they could invest their money and earn 8% or more, as we've been advertising since 2008. And so our mortgage pool fund right now has been paying consistently a little bit over 8% on a monthly basis to those who take monthly distributions. And you can elect, if you invest in our fund, not to take distributions. Maybe you have an IRA and you're looking for growth. And if you're a growth investor, you get the compounded return of dividend reinvestment. And that gives you a yield closer to about 8.4, almost 8.5. Now, the question from the listener was
about taking. Can you add to the investment and can reinvest or
right.
change from monthly distributions to reinvesting?
Right. Okay. So a lot of options when you invest in a mortgage pool fund. In fact, there's two types. First of all, just real quick, there's two types of mortgage investing that we offer. One is we have clients who like to invest in individual notes, and fact, that's how we started out in the business in 2008, was providing individual note investment opportunities for people who liked, most of them were experienced note investors. And there are a lot of people that have been doing this for many, many years and investing in individual notes. And then in 2013, based on demand, we created the Pacific Private Money Fund for people who did not have experience investing in notes but were interested in achieving high yields and having a portion of their savings invested in alternative investment strategies such as our fund. So among the benefits are, and this is different from investing in an individual note. When you invest in an individual note, you really can't add to the note, and there's normally not a provision to either take monthly payments or not take monthly payments. Usually, it's just it's like a loan to the bank. You have a piece, you either own all or a portion of that note, and that borrower is making that monthly payment, and you're getting your share of interest out of that note. And again, you wouldn't typically add money to it. I mean, it's possible the borrower might come back and say, hey, I'd like an additional advance, or I'd like to borrow more money. But that's very, actually, the exception. That actually rarely happens in our business. But in a fund, so you open up an account with $50,000, that's our minimum investment. What if you want to add to that over time? You absolutely can. In fact, most of our fund investors do that. They send checks. In fact, every week we get checks for additional investments. Anywhere from $5,000 to $25,000 is a typical additional investment, sometimes more if they sell a property or come into some savings. And then if you elect to take monthly distributions and you decide, hey, you know what, I don't really need this extra income, I'm going to switch to a growth investment strategy, yes, you can absolutely change that. So there's a lot of flexibility when, and this is true with most mortgage pool funds, not just ours. Our mortgage pool fund happens to be a California-based fund that mostly lends on Bay Area real estate, and we're a non-leveraged fund, meaning we don't use leverage to boost the yield. It's a pure yield based on the fact that most of our loans are around 9 to 10% is what the borrower pays, and the yields that we've been paying our investors in that fund after expenses, the net to them, not before expenses, but after expenses, the net yield to them has been over 8% since the fund's inception.
Very good. I had a question, Mark, and that is, I sometimes see ads for trust deeds and or similar things, advertising yields of 13%, 12%, really numbers that almost scare me.
Sure, they should.
Because they're so far above the risk-free rate of a treasury, and then you are, your fund pays roughly 8% or so, and so it clearly to me means that you must be getting a higher quality of borrower because the borrower is able to shop for a better rate if they have the qualifications or the property is secured and so forth. So can you talk a little bit about that?
Yeah, and this is my opinion. So I'm going to say a few things that are my opinion. One of them is that I believe our fund to be a relatively conservative fund. Some people would say, how could you use the word conservative and 8% yield in the same sentence? That's ridiculous. But I believe it's to be relatively conservative because the weighted average loan to value of the loans in our fund is between 50 and 60%. In fact, it's been hovering around 50% for the past year. So we've got a very, very well secured portfolio of loans, and we don't use leverage to boost that yield. So leverage means we don't use lines of credit or a warehouse line of credit. We're not borrowing against the loans in the fund at let's say maybe 4 or 5%, thereby increasing the yield of the fund. So that's how we achieve a pure yield of a little over 8% on loans that we on average charge the borrower between 9 and 10% in the San Francisco Bay Area. So any fund that you see advertising rates of 10% or more, I am going to guarantee a couple of things. Number one, if they're paying 10%, I guarantee you it's not a non-leveraged fund. They are using leverage. Maybe they're only using 20 or 25% leverage. And I do know some funds, specifically in California, based in Southern California, that use a 25% leverage factor, and they're producing a 10% yield on note rates of around 8, 9, and 10%. So they have to use leverage to boost their yield.
Which is okay if everything goes okay.
Yeah, again, there's nothing wrong with using leverage.
Bankrupt.
Right, it's just that we all know what happened in 2007. Yeah. So, using leverage, can concerns me there. If they're offering 12 or 13 or 14%, and I'm familiar with funds, I know of funds that are advertising those rates, the only way in the Bay Area or in California for that matter that you can have a California-based fund paying out that kind of money is doing high percentage seconds and construction and rehab seconds to people who you're making loans to based on a future value after they repair that property. So the LTVs, the loans to value, the loan to value amounts for in many cases will be 100% or maybe even more than that, because they're lending them the money based on the belief that they're going to invest that money in the property and it's going to be worth more at the end of the day. So those funds have a higher degree of risk and they have a higher default rate. So again, be wary. In the San Francisco Bay Area, we have among the lowest hard money rates in the nation. You can go out of state to other states if you're investing in a fund in, say, Arizona or in Texas or in the East Coast. Hard money is more expensive in many of those other states, and so their funds can pay a higher rate. But again, are you comfortable investing in other states? Personally, I know and understand the California real estate market, so obviously I'm very bullish.
Yeah, and if you start losing principal, that's going to eat into that 12% return. So how do people get a hold of you if they would like to invest?
So our website is pacificmoneyfund.com, pacificmoneyfund.com. If you forget that, but you remember our company name, which is Pacific Private Money, we also have a website there as well. That's generally where our borrowers go to, pacificprivatemoney.com. And our phone number, 415-883-2150. Call us, leave a message, or call us next week when we're open. We're open every day, 8 to 6. That's 415-883-2150.
Okay, and Mike, we'd forgotten to give out your information. You're talking about, when we come back, I want you to talk a little bit more about conflicts of interest, and Mark's got some great stuff about expensive real estate that is pretty unbelievable. But Mike, people probably, listening to the show, they have questions about 401k, their employer. Maybe they want you to kind of talk a little bit more about the conflicts of interest on a personal level. How do they get a hold of you?
They can reach me at 415-785-4585.
Okay, and it's Mike Zaglin from the Drone Investment Advisory.
Exactly.
Very good. Okay, also, if you go to bestinvesting.com, on our website, you'll see Mike's pretty face there. In your mug. Okay, here's our third and final trivia question. Again, the theme is general legal concepts. Which state has authorized the use of a firing squad as a primary means of execution? All right, the first three callers with the correct answer to that question win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer this question. Which state has authorized the use of a firing squad as a primary means of execution? Stay with us. The Best of Investing will be right back. Just fine.
I would say Utah because they ran out of WD-40 for the guillotine.
That's funny. You should say that. Use that line. I like that.
Oh, they're I was in charge of the WD-40, for God's sakes. Take away his pension. But
At the end,
Utah because Gary Gilmore was executed in Utah by firing squad.
Was he?
Yeah. So, you have to be pretty lucky to survive a firing squad, I would think.
especially with the one that, if everyone had the blank bullet, right?
Oh,
Right, they do that.
Somebody
has
got
them. That way they don't feel
conscious.
guilty.
Yeah. Wasn't me.
Maybe it wasn't. Yeah, exactly. Here, wait. Let me see if this one's live. It's funny. I had Al Adels on.
Wow.
And he wasn't in the studio. He was called. I called him, and I called his landline, and I was having a hell of a time with the mic. And then we realized it wasn't my mic. His landline, he was like walking away from the handset or something. He's getting the whole
He's good. Yeah. That's the way that goes.
Let's see which time we got here. Close enough.
And I thought it was your Shemp impression.
Certainly.
And Joe. Remember Joe?
Really,
Joe came along a little late.
But Shemp was one of the real brothers. That's right. I didn't care very much. All right. Well, welcome back to the Best of Investing. Edward Brown here, along with Mark Hunt and Mike Zalen. All these M's. Okay, third and final trivia question. Which state has authorized the use of a firing squad as a primary means of execution? Mike.
Well, now this is going to date me a little, but I remember Gary Gilmore being executed by firing squad in Utah in 1977. So I'm just going to guess Utah.
Okay, but what was the reason you said? Because they ran out of WD-40?
Yeah, WD-40 for the guillotine.
But you are correct. It is Utah.
Utah.
Very good.
Good.
Okay. So let's see here. Mike, talk a little bit more about conflict of interest, and then I want to get to these real estate things.
Sure. Well, we were talking before how you often hear about the suitability standard for brokers and the fiduciary standard for registered investment advisors. But even though I'm a registered investment advisor, we can all be affected by conflicts of interest. As we were discussing, if you have a client who comes in and says, I'm a little nervous about the market. I've got $400,000 or $500,000 here. We were thinking of either paying off a mortgage or maybe buying a second vacation home or even putting it into annuities. And as the first person who sort of does the intake or the first person that they need to be able. Everybody needs to be able to go to somebody for an objective, unconflicted view of whatever they want to invest in. Now, sometimes they already know enough. They know enough. They know they want to be in a trust, or they want to be in an annuity, or they want to be in the market, and they're very clear on that. But a lot of times they're not. They're simply looking for honest, objective advice about what are the pros and cons of all investments, because all investments have them. No investment is inherently better than another one. The stock market could have a compounded annual return of 9%. That could make you rich over 40 years. But what good is that if it goes down 10% and you sell because you're afraid? So that's not the right investment for that person. On the other hand, if you have an estate that you want to leave things to your children and you go out and you buy an immediate fixed annuity because you want peace of mind, well, you should know that that's going to affect how much you're going to be able to leave your heirs, because it's gone once you write the check to the insurance company, for the most part, when you buy a fixed immediate annuity. So everything's got a consequence.
Yeah, I think that's really important to make sure that people know when they're thinking about annuities and they're thinking about leaving money to their kids, that it's like, oh my gosh, this is gone. Sort of like Social Security just ends when you pass on.
Now,
except for those 6 million checks that keep going to dead people.
Yeah, that's true.
But there's the fiduciary standard, there's the suitability standard, and one of the really clear things to me is, well, the fiduciary standard is higher, but it's not foolproof. And the suitability standard, on the other hand, would allow a broker to basically sell a mutual fund that pays a 5.5% load or sales commission when a Vanguard index fund would have been just as good, well, actually much better probably. It's suitable, quote unquote.
How do you, let's say, go to the objection where someone says, well, my broker is showing me this, XYZ fund and compares it to a Vanguard fund and says, well, look, this one has outperformed over the last 20 years.
Right, and I've known some people who walked out of a craps table in Las Vegas who outperformed the casino that day. So there's such a thing as random performance. Of course, it's always possible to beat the markets. No one is saying it's impossible. We're only saying, or I'm only saying, I'm saying, I believe Warren Buffett and 25 other Nobel Prize winning economists and John Bogle, the founder of Vanguard, are in serious disagreement with what your odds are.
Well, yeah, because you're obviously, it's the same thing with the house. When you're doing gambling, it's like the odds are stacked in their favor. Can you beat them? Can you make money? Yeah. But if you just had to go, what are the odds? It's less than 50-50.
Well, it's probably something on the order of 5%, I would say, over 10 or 20 years, once you take taxes into account. Because if you're trying to beat the market and you're in a taxable account, by definition, to beat it, you must be trading, you can't just hold the index, which means you have to buy and sell far more frequently. that's one reason why actively managed mutual funds turn over the portfolio, almost the entire portfolio each year, generating short-term capital gains, a lot of short-term capital gains. Whereas most, I would say, large passive index funds turn over about 5 to 10% of the time.
Yeah, because the whole idea is just to buy the index.
So even if you, the point being, even if you beat the market, that would be on a pre-tax basis. And who cares about that? The only thing we care about, for you, is how much are you keeping? So if the market returned 8%, you got 8.5 because you made 5,000 trades to get the 8.5, but paid a third of that in taxes because it was all short-term capital gains. How much have you beaten the market by?
It's funny, in the old days it probably was worse when the commissions on buying and selling were a lot higher.
Sure.
So if people want to maybe have you take a look at their portfolio?
Yeah, my number is, I'm here in San Rafael. My number is 415-785-4588.
Do you ever have people maybe just email you their stuff?
No.
No, but pretty much you like to one-on-one.
They can certainly email me to set up an appointment.
And you'll fly all over the country. No, I'm just kidding.
And I usually do an initial review. I usually charge for 2 hours of my time. That's about what it takes typically to even see if they are where they are and what makes the most sense for them. And if it's not being in stocks, then it's not being in stocks.
No, but that's neat because it's almost always when you meet someone in the financial arena, they always recommend stocks, just a matter of which ones.
Right.
Mark, give us this interesting stuff you're talking about with the high-end real estate.
Sure. So there's there is some other good news in real estate that we didn't share in the This Week in Real Estate segment, and that is sales worldwide of $100 million plus homes are on the rise.
Yeah, because I sold 3 of mine. Yeah, all right.
So in 2014, last year, a record 5 homes sold for over 100 million, and there are currently 20 on the market right now that you could have your pick of that are selling at over 100 million, including 2 properties that are listed for over 400 million.
Come on, someone's got to ask $1 billion for a home just to do it.
I hope some of these come with their own islands.
Yeah.
I want a beach.
Or
a pool is just not going to do
wait.
it.
Does it at least have irrigation for the lawn? Or do you have to water it by hand?
I don't know if that comes with water rights. So,
okay.
So he goes, it's interesting. The article says you're looking at a universe of over 1,800 billionaires, which I wasn't aware that there were over 1,800 billionaires now, and growing, of course. It seems every week we add another billionaire to that list worldwide. And they got to do something with all that money. You can only have so many 400-foot boats. That's the other thing. They're always like trying to outdo each other for who's got the largest sailboat, who's got the largest power boat, and
but all it is money. I mean, seriously, it's one thing to say, hey, I'm Michael Jordan. Look what I can personally do with a basketball. It's another thing to just go, oh, here, who do I write a check to just kind of buy the biggest boat?
Well, you were talking about just let alone the taxes. Now, of course, these aren't all in the United States, but last year in the United States, a home sold for $145 million. So. Imagine the real estate.
Yeah.
I don't know what state that was, but
let's say
depending on the
California.
state.
Can you imagine? Your real estate tax bill is over $2 million a year.
By the way, how do California property taxes compare to most of the country? Does anyone know? Are they a little lower because of Prop 13?
Yes, lower overall. Generally speaking, most in most other states, home values are less on average, quite a bit less on average than in California, but it's not unusual for homeowners to be paying more in taxes for a home.
Percentage-wise.
Yeah,
Isn't that
quite a bit
like Oregon? I think it's
And that goes up every year as opposed to California where you're only hurt the first time, basically, because as the property rises, your property tax.
I think that's true, but the thing is, from a consumer standpoint, they don't have to, a lot of these states don't have sales tax. And that's how they get you, is for the homeowners have to pay the higher percentage in real estate taxes. It's kind of...
I doubt we're ever going to see a deal of Prop 13 in California. It's so politically ingrained now. It's yet another third rail in politics. Would you trust Sacramento, not to come up with ways to enhance the income through real estate taxes, or the counties for that matter? So it's just you know, as unfair and as there are many, many reasons why it ought to be looked at and possibly modified in some minor ways when it comes to the owner-occupied, the primary residence, your primary residence. I just don't see us ever allowing the foxes back into the hen house.
You know, the one thing, that's on a small level, but do you remember the governor? Do you remember he lowered the vehicle registration? He looked at that and he said, you know, we're paying way too, you know, everyone's paying way too much for their car registration. We were like, yeah, you're right. And then I guess when he got out of office, boom, went back up again. But I thought that was pretty cool. Go ahead.
What other conflicts of interest issues do we have that you often read about or hear about that maybe the public isn't quite aware of?
Well, you know, one thing I see when I review clients' statements at brokerage accounts is how often cash is sitting there earning 0.01%.
Yeah.
And my immediate thought is often, why isn't that in a CD earning at least earning close to 1%? I mean,
yeah.
It's, let's say it's $100,000. Sure, you're not going to get rich off of it, but it's $1,000. That's real money.
I guess the question is, you know, are they going to need that money soon?
Well, that's true.
I mean,
it
I
can
guess
happen. But I think it's a moneymaker. It's a moneymaker for brokerages. But I think the consumer should be aware. The more the consumer and the investor is aware of conflicts of interest potential, even like I said, even among fiduciaries, the better they'll be served.
Well, sometimes it's like, you know, when you talk to just a typical attorney, and you can tell that, oh my gosh, they're taking molehills, making them into mountains just so that they can up their fees. And, you know, that's a conflict too. Because rather than trying to settle something, it's like, well, let's drag this thing out.
Well, I can, don't ask me to defend attorneys. But you know, the thing is, look, Tony Robbins, who just wrote a good book on investments, I thought, had a great line. He said, look, if you go to a butcher and ask him what's for dinner, he'll recommend meat. And the same is true. If you go to an insurance salesperson, they're selling insurance products. Registered investment advisors like myself tend to make money managing investments. So, you know, ultimately the consumer needs to be educated, and there needs to be a lot of integrity in the profession, and that'll build those one over.
You know, it's amazing how many phone calls I get from people who call me in response to our radio ads advertising our 8% investment products, and they just have money sitting in cash, you know, or a money market account, and they don't have it in CDs because they just can't fathom the idea of locking up.
That's me. I can't imagine locking it up.
Even and the 6-month CDs don't pay anything anyway, right? But you know, you have to get into a 3 or 5 year or 7 year CD to make anything worthwhile. It's just it's amazing. It's a lot of cash out there.
Even there's some 6-month CDs paying 0.8 or so, and there's no penalty if you lose the interest or no or so.
Well, that's true. Okay, guys, we're going to cut out for the day here. Here's our sports thoughts for the day. The difference between a successful person and others is not a lack of strength, not a lack of knowledge, but rather a lack of will. Vince Lombardi said that. And former quarterback Todd Blackledge said the 6 W's: work will win when wishing won't. Think about that. All right, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of Martine, I'm Edward Brown, wishing you the best of investing. So long. 2 seconds left.